why knowing more keeps making you less. Right, let me show you something before I explain a single thing. This one go trade banked a clean 3-1, and I found it in under 20 minutes on a bear chart, running the exact same routine I go through every single morning. No 12 indicators. No 6 screens. No sitting glued to the charts from open to close. And here's the part nobody wants to hear. The reason most traders never get consistent isn't that they know too little. It's that they know too much. Every new indicator, every new strategy, every clever little tweak I bolted on over the years, almost every time, my results got worse, not better. The day it finally clicked was the day I binned about 90% of it and traded one repeatable pattern. The same setup, the same checklist, the same execution every day. It felt almost too simple to work. But stick with me, because by the end of this video, you'll be able to run that exact 5-step checklist yourself. And I'll walk you through the live gold example where every box lit up at once. The promise, what you can actually do after this. So here's the deal for the next 20 minutes. First, I'll show you why piling on knowledge quietly wrecks most accounts. Then I'll give you the whole routine in order. How I map location before I even think about an entry. How I filter the news in 90 seconds. The one signal that tells me a move is exhausted. And the 2 bits of confirmation I wait for before I click. Then the entry mechanics. The maths that lets you win less than half your trades and still come out ahead. And finally, how you grow this from a tiny starting stake without blowing up. Keep an eye out later. I'll freeze on the exact candle that got me into that gold short so you can see precisely what I was looking at in real time. Why more knowledge made me a worse trader. Why more knowledge made me a worse trader. Let's be honest about the trap first, because you're probably standing in it right now. Trading feels like it should be hard. We're wired to believe that a market this big, with this much money sloshing about, must need something complicated to beat. So we go hunting. A new indicator this week, a new candlestick pattern the next, a fresh strategy off someone's channel the week after, and every one of them feels like progress. It isn't. The traders I've watched struggle the longest are almost always the ones with the busiest charts and the fattest notebooks, hopping from setup to setup, convinced the next thing they learn is the missing piece. The missing piece was never another indicator. It was subtraction. The turning point for me was giving up on trying to catch everything the market does, and instead choosing one clean, repeatable moneymaker and running it to death. Same location, same trigger, same risk. I stopped caring about the 50 other moves I could have caught, and for the first time, my equity curve stopped looking like a heart rate monitor. Simplicity isn't a compromise here, it's the edge. A rules-based routine kills decision fatigue. It kills the emotional pull to chase, and it kills the self-sabotage that comes from making it up as you go. Step 1. Location before entries. Map the higher time frame. So here's the routine, in order. Every morning I open one chart, and I do the least glamorous thing in trading first. I mark location. Notice I said location, not entry. Most people open the chart already itching to click. I don't touch a 1-minute chart until I know where price is on the bigger picture. For gold Xauusd, my main instrument, I start on the 4-hour. I'm looking for the zones price has reacted to before, where sellers stepped in and knocked it back, where buyers absorbed the drop and lifted it. Those repeated reactions are your resistance and support zones. And note the word zones, not lines. The market doesn't respect a single thin line. It respects an area. Now here's why this matters more than usual right now, and it's a live example you can pull up yourself. Gold went absolutely vertical into late January 2026 and printed an all-time high up around the $5,600 region on the 29th. Then it did what parabolic moves always eventually do. It snapped back hard, shed a big chunk of that rally, and by early July it's been grinding sideways, roughly in the 4,000 to 4,200 area. That context is your bias. When a market is chopping sideways in a range, the highest probability assumption is that it keeps doing that until proven otherwise. So as price pushes up into the top of that range, into resistance, I'm leaning toward a fade, a reversal, not a breakout. I treat the market as most likely to carry on doing what it's been doing, and I put the odds at roughly 80% that the current behavior continues. That single assumption stops you fighting the chart. Practically, I draw a small handful of things and no more. The obvious high of the range and the obvious low. The overnight high and low, because London and New York love to hunt those. And if there's a clean sloping line the swings keep respecting, I'll add a trend line, an upper resistance trend line on a rising wedge, say. That's it. 4 or 5 marks. This map does one job. It tells me where to expect a reaction. So when price sprints into that zone, I'm not surprised I'm ready. If you draw 20 levels, none of them mean anything. Draw the few that price has actually paid for. Step 2, the 90-second news filter. Before I look for a single entry, I check the calendar, and it takes about 90 seconds. I use a free economic calendar, filter it to the currency I care about, and I'm only asking one question. Is there high-impact news due today that can move gold? And when? That's it. In this market, that means the big US data jobs, inflation, anything Fed-related, plus anything the central bank chair says on the wires, and the geopolitics that have been jerking gold around for months. Take last week as the perfect example. US jobs came in soft. Markets slashed their bets on the next rate move, and gold ripped over 2% in a session. If you're short into a number like that without knowing it's coming, you're not trading, you're gambling. Knowing the schedule doesn't mean you trade the news. It means you're never ambushed by it. Step 3, the exhaustion signal, the unhealthy move. Now the fun part. Price has run into one of my zones great, but a level touching isn't a reason to trade. Strong trends smash through levels all the time. So I wait for the market to tell me the move is running out of fuel, and I have one simple tell for that. An exhaustion move, or what I call an unhealthy move. Picture it. Instead of climbing in orderly steps, price suddenly lurches one big, greedy candle, far bigger than everything around it. That imbalance leaves a gap, a pocket where price moved so fast it skipped over fair value. On a chart, it shows up as a fair value gap. And the thing about a move that violent is that it's usually unsustainable. The market tends to come back and hand most of that candle straight back. This is my catalyst. When price pokes into resistance and does it with one of these ugly, overextended shoves, I get very interested because it flags a clean snapback. One honest warning. Though an exhaustion move on its own does not mean the trend is dead. Plenty of times price fills the gap, catches its breath, and carries on trending. I'm not betting the whole trend flips. I'm betting there's a high-quality reversal to trade, and I only take it when the next piece lines up. And a quiet note that'll save you money. These setups tend to pay faster on the short side because gold sheds altitude far quicker than it gains it. Fear moves faster than greed. When it goes, it goes. Step 4. Confirmation. The structure shift plus failed retest. Here's where most people jump the gun and where I used to hand my money away. When I want a reversal, I'm effectively calling the end of an uptrend and the start of a downtrend, and that is genuinely hard, so I refuse to guess it. I wait for the market to prove it to me. And the proof is written in the structure. An uptrend is just higher highs and higher lows, stacked. The moment that changes the first lower low, then a lower high, the character of the market has shifted. That's my third box, but I still don't click. I want one more thing. I want price to try to continue up and fail. That failed continuation is the whole game. After structure breaks, the market will usually throw one more push higher. It traps the last buyers who think the uptrend's still on. If that push stalls and gets slammed back down by a big rejection candle, that's my green light. Think about what just happened. Buyers tried, buyers failed, and they're now trapped above me. That's exactly who fuels the move down as they bail. So my fourth box is a failed retest right under a lower high, capped by an obvious rejection candle. When I've got the zone, the exhaustion, the structure shift, and the failed retest 4 boxes, I'm finally allowed to think about an entry. If any box is missing, I don't trade. And if the whole day never lines up, I close the laptop and go and live my life. No setup, no trade. That discipline is the strategy. Quick one if this is landing. Quick pause if the checklist is starting to click. Do me a favor and tap the like button. It genuinely helps the channel put these breakdowns in front of more traders who are drowning in indicators. Right, back to it. Because now we get to the click and the maths that makes the whole thing work, even when you're wrong more than half the time. Step 5. The entry and the maths that carries you. Let's talk about the actual click, because how you enter matters. I don't sit there with a market order twitching to buy the exact tick. Once I've got my failed retest, I place a sell stop order a touch below that rejection low. A stop order does something a limit order can't here. It only triggers if price actually trades through my level and confirms the breakdown. If price never breaks, I never get filled, and I've risked nothing. If it breaks, I'm in the moment. Momentum agrees with me. On that gold example, price rejected the lower high, rode over, and my order triggered as it sliced back below the minor support, underneath, right as the door opened into that empty pocket, the exhaustion move left behind. Those pockets fill fast because there's very little volume in the way. Now the maths, because this is what lets ordinary people trade for a living. I only take reversals that offer at least 1 to 2, and I love a clean 1 to 3. Risk 1 unit to make 3. Why does that matter so much? Because it means your win rate can be genuinely mediocre and you still make money. At 1 to 3, you only need to be right about 3 times in 10 to break even. Everything above that is profit. Flip it around. If you trade a lousy reward to risk, say risking 100 to make 50, every single loss now costs you 2 wins to repair, and that is brutal on your head as much as your account. I've lived on the wrong side of that maths, and I'm never going back. Put the numbers in your favor and let a 30 to 40% win rate quietly grow the account. Managing the trade without giving it all back. Getting in is half the job. Not giving the profit back is the other half. My stop goes just above that failed retest, the level that would prove me wrong. And my first target is roughly 2 times that risk, usually the range low or the overnight low sitting underneath. If I'm honest, this is where beginners should keep it boring. Set a fixed target at 2 or 3 times your risk and let it hit. Managing a fast trade live, by feel, is a skill that takes time. Don't start there. On the gold short, my first soft target was the prior lows. The moment price got moving, I trailed my stop down behind each closing candle, because on a clean break, every 1-minute candle can be worth a chunk, and I refuse to watch a 3-hour winner turn into break even. There's a subtle shift here that matters more than any rule. Don't only think about your reward to risk. Think about where you are in the move. As price drove into the more major support and the fall itself started to look overextended to the downside, I tightened right up. Because the same exhaustion logic that got me in short now warned me a bounce could be coming the other way. Around 3R, I'll happily bank a chunk. If it's still printing lower candles with force, I'll let a runner breathe. 2 questions run the whole exit. Is the reward still worth the risk from here? And has this move started to look exhausted itself? When the answer flips, I'm out. No hero trades. Scaling from a tiny stake the same way. Let's talk about growing this. Because the honest version is less sexy than the adverts, and far more likely to keep you in the game. You do not need a big account to trade this. Start on a demo always when you're learning a platform or a new setup, and prove to yourself you can run the checklist for a few weeks without deviating. Only when the routine is boring and repeatable do you go live, and you go live small. The number that matters isn't your position size, it's your risk per trade. Keep it to 1 to 2% of the account, full stop. That single rule is what lets you survive a losing streak, and you will have losing streaks even with a good system. Scaling then becomes almost boring, which is the point. As the account grows and your execution stays clean, you increase your position size in small, deliberate steps, not because you're feeling brave, but because 1 to 2% of a bigger balance is simply a larger number. The setup never changes. The checklist never changes. The routine still takes 45 to 60 minutes around the session that suits your time zone for a UK trader. That's the London Open and the New York overlap, which is where gold does most of its damage anyway. You can run this alongside a full-time job. What grows is the account, not the complexity. Please hear this clearly though. This is a skill you build, not a lottery ticket. There's no guaranteed number. Results vary, and anyone promising you certainty is selling you something. The exact numbers on that gold short. Let me put real numbers on that gold trade, so it isn't just theory. Price pushed up into my resistance zone in the upper half of the range, through the exhaustion candle, then broke structure with a lower low and gave me a failed retest right under the lower high. I placed a sell stop a few pips below the rejection low. Entry filled around the break. My stop went just above the retest high. Call it a 30 pip risk on the setup. First target was the range low, sitting roughly 60 pips below, so 2R. And the runner went for the overnight low beyond that, which is where the 3R came from. Same maths. Whatever the account size. If I'm risking 1%, that trade returns 3%. If the stop had hit, I'd have lost one and moved on. No drama, no revenge. Next setup. Same checklist, different pair, GBP USD. And to prove this isn't a gold-only trick, run the identical checklist on GBP USD around the London Open perfect for a UK trader. Because that's when cable actually moves. Say sterling rallies into an obvious overnight high that also lines up with a session resistance zone. Box 1, location, tick. It gets there with one greedy candle that gaps away from the pack box 2, exhaustion, tick. Then it prints a lower low, rolls a lower high, and the pushback up fails on a fat rejection candle boxes 3 and 4, tick, tick. Sell stop below the rejection, stop above it, target the prior session low for 2R. Nothing about the process changes. The pair changes, the levels change, the time of day changes, the 5 boxes do not. That's the whole point of a repeatable system. You carry it, not 100 separate setups. The 2 mistakes that quietly kill this system. Even with a clean checklist, 2 habits will bleed you, and I've done both. The first is overtrading, forcing a setup on a day that never offered one. Your brain hates a blank day. It whispers that surely there's money out there you're missing. There is, and it's not yours to take. If the 4 boxes aren't there, sitting on your hands is the trade. The second is meddling with your stop in the wrong direction, nudging it wider because you feel the reversal is still coming. The instant you widen a stop to avoid being wrong, you've abandoned the plan and turned a defined risk trade into an open-ended one. Move stops to protect profit, never to postpone a loss. Practice this week the 3-0 setup drill. Here's a drill you can actually do this week, and it's the fastest way I know to trust a system. Open the gold or cable chart, scroll back, and hand count 30 examples of the full 4-box sequence: a zone, an exhaustion candle, a structure shift, a failed retest. Mark where you'd have entered, where the stop sits, and where 2R and 3R land. Don't trade a penny yet, just log the outcome of all 30. What you're doing is proving to your own eyes that a 30 to 40% hit rate with these payoffs comes out ahead, so that when you're live and you take 3 losers in a row, you don't panic and rebuild the whole strategy. Conviction doesn't come from a guru telling you it works. It comes from you watching it work 30 times with your own hand. One last habit that ties it all together: keep a one-line journal. After every trade, win, lose, or the days you correctly sat out, write a single sentence. Did all 4 boxes show up? Yes or no? Did I follow my exit plan? Yes or no? That's it. Within a month, you'll spot your real leak. And I promise you, it won't be your entries. It'll be the days you forced a trade that wasn't there, or the stop you widened when you should have taken the loss. You can't fix what you don't measure, and one honest line a day measures the only thing that matters. Did I run my own process, or did I improvise? Trade the process, log the process, protect the process. Everything else is noise. The 5 boxes, one more time. So let's lock it in. 1. Location before entries map the few zones price has actually paid for on the higher time frame, and let the range give you your bias. 2. The 90-second news check, so you're never ambushed. 3. Wait for an exhaustion move into your zone, that overextended candle that leaves a gap. 4. Demand a structure shift and a failed retest before you even think about clicking. 5. Enter on a stop order. Risk 1 to make 2 or 3. Protect the profit and size at 1 to 2%. Miss a box, skip the trade. That's the entire edge, not more knowledge, just the discipline to do the same simple thing, well, every day before you go. If you got value from this, subscribe and turn on the bell. The next breakdown drops every week, and I'll be taking one clean setup at a time and pulling it apart the same way. Drop a comment with the pair you want me to map next. Gold's my home turf, but I'm happy to run the exact checklist on GBP USD or the indices too. Go and mark your zones tonight. Run the checklist on demo tomorrow, and let the boring, repeatable version of trading do its quiet work. And the important bit, none of this is financial advice. Trading carries real risk. You can lose money, so manage your risk at 1 to 2% per trade, and never risk what you can't afford to lose. See you in the next one.